This was a buy trade I took right here. This very trade gave me 10 RR. Now, this was when I had the opportunity, when I had the setup. Now, this is another buy I took. This other buy gave me 4 RR. And this was when I had the buy opportunity right here. Now, if you watch, this second trade now was dropped in this very group where I said, that's your entry. It's kind of risky. I prefer the BB. Now, these are other trades I took. This is a buy I tried taking. This buy went against me, of which strategy does not work 100% of the time. So this very one did not go as I was expecting. Now, this is another buy I took. This very trade now gave me 4 RR. Now, this is another buy I took. This other buy gave me 4 RR. In this very video, I'm going to teach you guys a complete structured liquidity POI trading course. People pay thousands of dollars for this type of video, but I'm going to teach you guys for 100% free. I'm going to give you the beginner aspect to a point where I now execute trade. What I look out for in taking trade, everything, right? Once you are done watching this very video, you'll go over to your chart, replicate it, and you're going to see similar results. So I'm not going to waste time. Let me begin. Now, the strategy I use is called the SMC, which is the Smart Money Concept. Many of you already know that, the SMC, right? The Smart Money Concept. Now, what this strategy helps you do, it helps you trade like the institutional traders. It helps you trade like the banks. Now, remember, these institutional traders now, they always want you to get involved in a demand zone. And they want to buy at a lower price, and they want to sell at a supply zone. They want to sell at a higher price. And, they need liquidity. Now, I'm going to explain everything so you can easily understand it. Now, these are the 3 things I use with this SMC. SMC is wide. We have a lot of things with this smart money concept. We have your fair value gap, mitigated block, different names, right, with this very strategy. But these are the 3 things I use. It's very simple. The first one is the structure. And this structure now is just the trend to know what direction the market is trading on. So that's the trend. Then the second one is liquidity, which liquidity is going to help fuel the move. I'm going to explain it. Then the third one is the POI. This POI now is my point of interest, right? My point of entry. Those zones where I'll be taking the trade from, where I'll be taking the buy from, where I'll be taking the sell from. Now, the very first one, which is structure, like I said, is a trend. The trend of the market. And in knowing the trend, or overall the trend, we have two main trends: the bullish trend and the bearish trend. These are the ones I trade. We have 3 trends in the market: the bullish, bearish, and the consolidating market. But these are the only 2 I trade. I'll let you the bullish and the bearish market. So bullish market now helps me know, okay, this market is trading going up, right? And I'm meant to keep looking out for buys. I'm meant to keep looking out for buys on this very market. Then bearish market now shows this market is going down. I'm meant to keep looking out for sales on this very market. So with this, I'm able to know, okay, if I'm on this chart now, I'm meant to look out for buys or I'm meant to look out for sales. Now, how do I know that a market is bullish or a market is bearish? Now, like I said, bullish now is when it's going up. The price is trailing up. Gold has been going up for over a month, meaning gold was bullish at that very period. It was going up. It was creating a higher price. Let me show you on the chart. Now, if you watch, this trade I took now were buys. And if you watch, this market now was going up because it got here, it retraced, it created a higher price. It got here again, retraced, it created a higher price. It got there now, retraced. It's currently now about to create a higher price. So showing that it's creating higher prices. Price is going up. At the time of me recording this very video, gold is over $4,000, about $4,017, right? So that's the current price. So gold price is going higher, bullish. Now, how do I know that this market is bullish? That means I should be looking out for buys. I'll be looking out for sales. I personally use the break of structure. Now, BOS. Now, break of structure is a break above a high or below a low. Notice this. This is a high, a point where price got to. I'm just trying to use it to illustrate it. Then I'll go to the chart and I'll show you. A point where the price got to. Then on coming back up, it broke above it. Price got there the first time, came back down. On going back up, it broke above it. That's a high. Price broke above. Same thing, it has another high. Coming back, breaking above it. That break is a break of structure. So I'll indicate it with my trend line, mark it out as my BOS, where the price broke. Now, this is a high and the price broke above it. But in a case where it's now breaking to the downside, this is a low and it broke below it. This is now a break to the downside, showing that this market is bearish and meant to look out for sales. This is another low and the price broke below it. So this break of structure that breaks to the downside. Now, this is the chart right here. This was a high. Price that is very high right here. What happened? It broke above it. That's a break of structure to the upside. Then if you watch, price had this other high right here. Price broke above it. That's a break of structure to the upside. So what is it showing you? That this market is bullish and it's creating higher prices. It's creating higher price. And what do you expect? This is another high. The price just created. It's done retracing and it's currently going up, and you expect it to break above it again as a break of structure to the upside. So this market now is bullish. It's creating higher prices. Then if it's bearish, it's going to be break to the downside, just like that. Now, what's going to make a break of structure valid? What's going to validate break of structure? Not all breaks are valid, right? What's going to make it valid? Now, we have only one thing that's going to make a break of structure valid. That's going to make a break of structure not valid or valid. First one, it should be a break with a full candle body. Now, it should be a break with a full candle body. Now, what this means is, if you're going to consider any level as a break of structure, you should break it with a full candle body, like this very example. Price having this high, it came down. On going back up, it broke past it to a full candle body. In a scenario where it broke past it with a wick, where it breaks past it with a wick, let me find an example. Where it breaks past it with a wick, that is not a valid break of structure. Like this very example right here. Price had this low. This is a low. The point where the price got to. Then on coming back down, it broke past it. You can see how it broke past that very low. A low. Price went up. Coming back down, it broke past it. This is not a break of structure because this is a long wick that broke past it. This is what we call sweep. And this price is using it to hunt for liquidity, to generate liquidity. So this is what we call sweep. Now, this is not a valid break of structure. That's the only thing that's going to make a break of structure not valid. Now, that's all for break of structure. That's going to help me know the trend or what I will be doing in the market. If I'll be looking out for buys or I'll be looking out for sell. Gold, when it was bullish, it was breaking structure to the upside. It had this high. What happened? It broke past it to the upside. That's a BOS. Now, with this, I'm able to know I'm meant to keep looking out for buys, not sells. That's another high. It's broke past to the upside. That's another BOS. But at some point, it's going to break to the downside, of which most of them are not valid, right? Most of them, they are sweeps for you to continue the buy, which I'm going to still explain later on. Now, if you watch another high, price broke past. So those are break of structure showing that this market is bullish. Then the second thing is a change of character. Change of character now is a sign of reversal. A sign that this market is now changing from maybe bullish to become bearish or bearish to become bullish. You know, on the normal, since the price has created a higher price, it's meant to come down lower to a point maybe here, then go up to break and then create another higher price. But now, if it now goes down and then break this very low, this is now what we call a change of character. Now, why do we refer this? This is also a break of structure. But since it's the first time the price is doing it, the price has a break to the upside, but this is the first time it's breaking to the downside. That's what we consider as a change of character, right? A shift. Some traders are going to call it a shift in market structure, right? But me, I call it change of character. You can see it right here. This is the first time it's doing the opposite of what it has been doing. It has been breaking to the upside, but this is the first time it's breaking to the downside. Same thing. If this price goes up now and break to the upside, now that's a change of character because it's the first time it's doing it. Now, if you watch, go down the change of character at this very zone right here. What happened? It had this break of structure to the upside right there. And if you watch, it had this break to the downside, validating a change of character. You can see that because it's the first time it's doing it. And immediately did that, what now happened? Gold started going down. I guess that was why I lost this very trade. I was still trying to buy, but what happened? Started going down. If you notice, it didn't break that high again. It's not expecting more of sales. It's not breaking to the downside. Another low, price broke past it just like that. Now, what's going to make a change of character valid? There are only two things I consider. The very first thing I consider is it should have a BOS, meaning you're going to need a BOS to validate a change of character. Then the second thing I consider is that it should happen at a key reversal zone. Now, these are the only two things I consider. First thing, you should have a break of structure, and this is what that means. If you're going to consider this high as a change of character, which is the first time it's doing it, that's breaking to the downside now, but this is the first time it's breaking to the upside, you want to watch and then see that it's first broke to the downside. It should have, let me put it this way, in a simple way you're going to understand it. It should break structure to both sides. It should break to the downside and break to the upside. So validating a change of character, just like that. Now, the second thing, it should happen at a key level or at a key reversal zone. I can't just go to the market and then start saying price has given a change of character. Notice when I started buying, notice why I started taking this very buy. I started taking this very buy. Market was bearish. You can see it's break structure to the downside, another break of structure to the downside from this very low right here. This is the lowest point it got. So that's another break of structure. Then it breaks structure to the downside, right? But on getting to this very point, this was a key reversal zone, a key zone that it's not traders are going to likely step in for a buy. It's a demand zone. So on getting there, what happened? It gave a change of character. That was now why I started looking out for buys. If you notice, it was going down. I meant to look out for sales. But now, since it gave a change of character at this very zone, I started looking out for buys. I took my first buy. I took my second buy. So I'm currently watching to take my third buy. Why? Because it has gotten here. It has a possible reversal zone. So these are two things that's going to make a change of character valid. So this is the first thing with this very strategy. Now let's move on to the second thing, which is liquidity. Liquidity is money within the market. Now, if you are in a trade, right, you take a trade and that trade goes in your favor, you make money. You hit take profit now and you make money. On that very market, you are taking liquidity out of that very market. That money you made is liquidity and you are taking liquidity out of that very market. Same thing, if that trade goes against you and you hit stop loss, you are providing liquidity for that very market. So liquidity is money within the market. Orders and stop loss are the liquidity, right? Which orders, you enter a position, you enter a trade, your money is now into the market. If the money is still in your trading broker, you didn't take any trade, it's still your available equity, you can easily withdraw it. But as far as you are now in a trade, that your money automatically is now a liquidity available to the market. Now, if the trade goes against you, hit your stop loss, you're going to lose money. And liquidity is all the market wants. These are the two key points I do give. Liquidity is all the market wants. And our stop loss as SL, if you lose money, you're going to provide liquidity for the market. And that liquidity, many of you are going to ask, why is it needed? Why does the market want to look out for our liquidity? Why does the market want us to hit stop loss? And this is the reason. Now, for institutional traders to get involved, they need liquidity. They need money. They need sufficient pool of liquidity in the market. Liquidity is money. For them to enter a trade now, they're going to enter with a large capital. So for them to get involved now, they're going to need enough money in the market so they can get involved. It's just similar. You want to buy something, you're going to need the quantity available you want to buy, right? So that's just what it is. So if they want to open a position on gold now, maybe 10,000 units position, right? Using 10,000 lots, they're going to need enough liquidity to fill their orders. So what are they going to do? They're going to first stop traders out. And what happened? This was a nice zone. This was a nice zone traders are going to buy from. But once they buy from there, they're going to have, once they buy from there, they're going to have their stop loss below the price. They're going to have their stop loss below the price and they can say, let me take my profit right here. Automatically, on getting there, their orders are being filled. But now, there was not enough liquidity to push the price up from that very zone. So what happened? Price had to take out that zone first. On taking out that zone now, those traders got stopped out. If you yourself, you tried buying from here, you have your stop loss here, you also get stopped out. And now you've provided liquidity for the market. And what will happen? The price will start buying from this next zone. Why? Because liquidity has now been gotten. Its natural traders can now get involved at the nearest POI, at the nearest buy zone. This was the first buy zone, but the price did not buy from here because there was no liquidity. On getting the liquidity, now the price will now buy from the nearest buy zone. Now, our stop loss, which you already saw, that is liquidity. These are three liquidity I use. Three things you can easily watch out for. Just see these three things. Just you need one of them, but these are three case scenario what I watch out for. Just watch out for just one and you use it. So let me replicate it with a pattern, then I'll go to the chart and show you. Now the first one is the first pullback after break of structure. You know, BOS, I said it was a break of structure. Now what this means is the price is gonna goes up, right? Go up, come down. It's gonna go up again to break that very point as a break of structure. On breaking that structure, the first time the price is gonna come back down, automatically that retracement is gonna act as liquidity. This is a first buy zone. Then this is a second buy zone, which demand zone. Those who trade support and resistance, this is a support zone. I'm going to explain it. It's the third thing with the strategy. But in this case now, price had this break of structure, second break of structure. This first zone I was now used as liquidity for this second zone. Why? Because market needs liquidity. So price is going to take out this first zone, then respect this other zone. So automatically this first pullback, the first retracement the price is going to do after that break of structure is a liquidity with this very strategy. So if you are watching out to take a trade, you want to check if you are the liquidity, and you know if you are the liquidity, you are going to need to stop, and then at not being the liquidity. Now look at a nice example. Price had this break of structure, immediately broke this structure. Now automatically it had this retracement, it came back down, then continued the buy. Automatically this retracement now is now a liquidity, and unless this retracement have its own liquidity, it's not valid. It's gonna act as a liquidity protecting this lower zone. So this is now an inducement, then this is the valid zone to buy from. So this is not the first pullback. The second case scenario is an internal pullback. In this case, it won't break structure before creating the liquidity. So this is a break of structure. It was after the break of structure that it created the liquidity. But in this second case, which is the second one, the second is the internal pullback before a BOS. Now, before it breaks structure, it's going to have the pullback. It's going to have the retracement like this. Right, before it eventually got to the break, this is a high, price came down. On going up, it had this retracement, then break structure. So automatically, this low now is acting as liquidity, protecting this very second buy zone. Because here we also have two buy zone, which is this demand zone, right, and this second lower demand zone. But this first one will not be respected because it does not have its own liquidity. If it had its own low, a low like this, then it's going to be valid just like that. And this was one of the one I used for this very buy. This was the one I used for this very buy right here. Right, now watch this closely. Before the price break structure, it had the retracement. It had the liquidity before it broke structure. Now this is a sell, right? Now it had this other low, break of structure to the downside, but before it eventually went down to break structure, it had this retracement push up. This retracement now acted as liquidity before it finally broke structure. That retracement acted as liquidity, protecting this very sell zone. So I'm coming back up, started dropping. Now this other buy I took, notice this liquidity I used. Immediately the price broke structure. Now this very high break structure, it had this retracement. This pullback automatically acted as liquidity, protecting this my buy zone. So that was why I called this very buy. I'm going to show you everything. Then the third liquidity we have is the engineered liquidity. Now the third liquidity we have is the engineered liquidity, and in this case, this is what happens. Many of you know this, but many of you don't know it, right? In this case, this is what happens. The price is going to have a high, then retrace, then maybe break structure. But after breaking structure, it does not have any pullback. It didn't have any other internal pullback. It didn't have any frost pullback. But on coming close, it's going to create a low, go up, take out that low. Then I'm buying. So this low it created now is an engineered liquidity. This very low right here. Why? Because it's going to make traders jump in. Right? It's going to create an illusion that's going to make traders jump in. And this is a nice example on how I caught with this very trade. Now watch this closely. On coming close to my POI, this is what happened with the engineered liquidity. On coming close to my POI, it got here. This was the POI I was using. It didn't get there. It didn't tap on the POI, but it came close and went up. If you notice, it even gave a change of character. So traders, they will start thinking this market has left. This price has left us. Then it will start going up. And they'll start jumping on buy and having their stop loss below this very low. And what tends to happen? The price will go down, take them out before it will eventually start moving. So this is now engineered liquidity. Why? Because there's no frost pullback. There's no internal pullback protecting the zone, the buy zone. So price had to engineer liquidity to take traders out, then started buying. Now, those are the three liquidity. Now, what's going to make liquidity valid? Right, what's going to make liquidity valid for you to take a trade? There's only one thing I look out for. There's only one thing that makes my liquidity valid. The only thing is that it should be close to your entry. Should be close to your POI. Should be close to your entry. You know, POI and entry, they mean similar thing. Right? POI, like I said before, is your point of entry, point where you likely take your trade from. So the liquidity should be close to your POI, which brings us to the third thing with this very strategy, which is the POI. POI is an extremely important aspect of this very strategy. Why? Because it's now your point of interest, literally your point of entry where you enter the trade. Now, the first two things, you now know, okay, this market is bullish. I'm meant to look out for buys. Then, okay, all of these lows now has liquidity. All of these highs has liquidity. But where will I now enter this trade from? Where will I now set my buy limits or set my sell limits on? They are now the POI. And there are two POIs I use. These are the only two POIs I use. The very first one is the order block. And many of you have heard of what order block is. Order block is where we have large resting orders, where institutional traders are waiting to take their trade. Then secondly, there are also levels where institutional traders has previously executed their trade, where they have previously entered the market. Now, generally, order block is the last opposite candle before an opposite move. And this is what that means. Now, on going down, price was going down. Let me show you a nice example. Price was going down at this very zone. Price at this sell. On going down, it got here. What happened? It continued the buy. So the order block right here now is the last bearish candle before the bullish move. Just take it this way. Like I said, the last opposite candle. So if it's going down now, it's going to be this black candle. My chart is black and blue. On your own chart, it's going to be the last red candle before I started showing green candle. Right? So the last opposite candle is the order block. So we do mark it out with a rectangle too. So this is the order block right here. And this is now a zone where I'll be buying from, a buy zone. Now, long wicks, right? You can also mark out long wicks, and those long wicks can also be your order blocks. Let me show you. And let me write it out in brackets, comma, long wicks can be order blocks, can be your OB. Now, this is what that means. If you have a long wick, in a case where you have long wicks, like this very one now, this is a long wick. And this very long wick now, I can indicate it from the very beginning of the wick to the point where the wick stopped. I can mark it out as my order block. So this long wick can as well act as order block. Long wick, not tiny wicks. This very one is a tiny wick, and I can mark it out. Now, long wick, you can't say it need to be a bullish or a bearish long wick. As far as a long wick, this is another long wick right here, is an order block. Right, this is not a long wick. I can mark this out as an order block. This is a long wick. I can mark this out as an order block. Now these are long wick. If there are multiple wicks now, I can also mark it out as an order block. So this long wick can act as order blocks. Right now, those are the two case scenarios. Those are the two ways you can mark out order block. Order block, they are generally the last candle. If you notice, if I'm going to mark out an order block right here, it's going to be this black candle right here for generally what order block is. But this long wick now is the order block in this very case. Why? Because on a lower time frame, this long wick is an actual order block. I'm on a 15 minutes time frame. If I go to 5 minutes time frame, if I indicate this very zone now, and I go to a 5 minutes time frame, this can easily show that it's a black candle, right? It can show that it's an opposite candle, and you can see that clearly right there. So this was the point, and this was the long wick we marked out on a 15 minutes, but on a 5 minutes time frame now is an actual black candle. So this can act as order block. This is obviously an order block, but in the higher time frame it was showing a long wick, which those long wick now they are as well order blocks. Now, like I said, order blocks, they are last opposite candle before an opposite move, and that's how we mark it out. We can mark out the long wick as an order block, or we can mark out, if there's no long wick, generally we mark out the last opposite candle right there. And if you watch all of this trade I took, this very buy I took it from a breaker block. I'm going to explain it. If you notice what I marked out, this very last blue candle, it was for a sell, but since the sell failed, it was now for a buy. Right, if you notice that our buy that happened, it was from this very order block right here. Notice the price was going down. On going down, getting to this very order block, started buying. And if you watch this very buy I took right here, what did I mark out? This very long wick below the price. This was what I marked out. Then I used it to take my buy. Right, if you notice where the price respected now, it was this very long wick right here. So long wick can act as order block in a case where there is no clear order block. Then the second POI I use is the breaker block. I believe you heard me mentioning breaker block. Now, breaker block are failed order block. Just the same way your support fails, turn into resistance, or your demand fails, turn into supply. That is the same way order block can still fail. Once they fail, now automatically they are now breaker blocks. Now, this is a nice example. This is the last blue candle before price started going down. But on coming back up, price just came back up and broke out. Did not respect it. So on coming back there, it was now a valid zone to buy from. So I took my buy and watch. Price just respected it and went up. Now, you can't just mark out order blocks and then you start jumping on trades, right? There are things that's going to make an order block valid. Right? There are two things that's going to make an order block valid. First thing is that it should have a BOS. Then the second thing is that it should have liquidity protecting it. Now, these are two things that's going to make an order block valid. If these things are not present, meaning that your order block is not a valid zone to buy from. Now, if you watch with the whole strategy, now they combine each other, right? They work hand in hand. Now, first, I've marked out this breaker block for my entry to buy from. I want to buy from this very breaker block. Then if you watch, this breaker block has this high and it's broke past it. That's a break of structure. And what's that telling me? That this market is bullish. And if you watch, we have another high. Price also broke past another high right here. Price also broke past it. That's another break of structure. Showing me that this market is bullish. I'm meant to look out for buys. Then if you watch, this low acted as liquidity. The three things are now complete. First thing now show that this market is bullish. Break of structure, break of structure, break of structure. Right? Then this first pullback immediately broke the structure. Now this was the first retracement it did. It was the first time it's pulling back down. Acted as liquidity. Then I take the buy from the breaker block. I took my buy. Price went up straight up to take profit. Right? Now why? Because market is bullish. There's liquidity and my point of interest breaker block. You can see the strategy is working together. Those are three things I need. Now for order block to be valid, should have a break of structure. If I'm going to mark out any order block, to take my buy from, it should push the price up to a break of structure. The price having a high goes down, creates an order block. If it does not go up to break that previous high as a break of structure, that order block is not yet valid until it breaks that structure. Then once it comes back down, I can buy from the order block when there is liquidity protecting it. So those are two things that's going to make an order block valid. And let me show you order block that is not valid, and you will see it right away. Let me show you another block that is not valid, and you're going to see for yourself that the price will not respect it. Let me find a nice example and then show you. And if now this is a nice example right here, I've seen a nice example. Now watch. Price that is very order block. You can see this order block right here. This is an order block for a buy. Price that is order block. On creating this very price goes down, creates the order block. On creating it, it had this internal pullback, which acted as liquidity. Then it did not break structure. It didn't break this previous high. So there was no BOS, meaning this order block is not valid, though it has liquidity, but there was no BOS. So obviously, this is not valid. So what happened? Price just came, violated the order block, did not respect it. Why? Because if it had broke structure, then the price will come down, respect it, and continue going up. So they work hand in hand. So these are three things with this strategy, right? And these are three things I use to approach the market. Now, the final aspect of this is now how I do it. The different time frame I go to. Once I go to the market, what I look out for, and how I eventually end up taking this very trade. Before I go on, if it's the first time coming across this very YouTube channel, you are highly welcome, and you are watching the Day Trading Geek. My name is Goswell, and I create YouTube video for this very channel to help you guys become profitable. So if it's the first time, do well to support the channel by liking the video and subscribe so you get more videos like this, right? And before I go on, I have a mentorship class where I teach people how to trade. Now, the mentorship class, I teach you the strategy and everything, right? But the main course of the mentorship class is for me to guide you, take your hand, and then guide you on how to become profitable. You can watch my YouTube video, you go to your chart, start applying what I'm teaching, then you're going to have a lot of questions. You're going to do some things that is going to make you hit stop loss, and you can't come to me and start asking me questions if you are not my student. But if you're my student, I have a group where you can easily ask questions. Me personally, I'm there. I'll reply you, give you my feedback, give you my expectation, show you what you did wrong, and then you correct yourself and then move on and then learn. And we have other traders there as well that are ready to also help you. The traders who have been trading for some time, who are profitable, that's going to also guide you in the mentorship class. So it's just me training you until you become profitable. I guess I received a couple of testimony from my students on my notification while recording this very video. Right, I'm going to post on the Telegram. My Telegram link is in the description. It's 100% free. So this is the Telegram right here. The link will be in the description right of this very video. Now notice this is a general group for September group. This is a September general group. And if you watch, this person sent a buy on gold. He said he was expecting a buy. Then he tagged me and said, my name is Goswell. Then he said, Goswell, please check this out and confirm it's valid. So I said that your breaker block is kind of risky, meaning the opportunity he had was kind of risky. Then I said, I prefer this breaker block, right? So I sent him the setup, and that was one of the setup I showed you guys earlier. This very one that played out, giving 1:4 RR. So all he had to do now was just to redo his analysis, correct himself, and then follow it the way I've given him. So with that, he's my student. He was in September class, which is last month. This month is currently October class. So to join the mentorship class, about $40. And if you want to gain access to me one-on-one, I'll teach you one-on-one section. I also offer one-on-one section. Link is in the description to join. So that's by the way, if you wish. Then let's go on. Now, how do I now go about this every single time? Once I go to the market, the first thing I do is I go to higher time frame. So I do top-down analysis. Right? With this strategy, I do my top-down analysis. Now, many of you are going to ask, what's top-down analysis? Top-down analysis is you analyzing from different time frame. Right? Starting from maybe a higher time frame to a lower time frame, or a lower time frame to a higher time frame. But you won't just go to 15 minutes time frame, start looking out for order block, break of structure, liquidity, and start buying or selling. So you want to make sure you are starting from maybe a higher time frame, from a lower time frame. That's what top-down analysis is. But me personally, I tend to start from a higher time frame. So my top-down analysis now starts from a higher time frame, then to a lower time frame where I finally now take the trade, right? So the time frame I use, these are the different time frame I use and how I go about it. The very first higher time frame I use is the 1 day. That's my highest time frame because I'm a day trader. Then the second time frame is a 4H. That's another time frame I also use. Then the third time frame is a 2H. This is the third time frame I use. These are my 3 higher time frames. These are time frame I consider as my higher time frame, and I'm going to show you what I do on these different time frames. Then for my entry to execute my trade, I use 1 hour as my entry time frame, 30 minutes, and the 15 minutes time frame. These are the 3 time frame now I use for my entry. Sometimes I do go to 5 minutes time frame. 5 minutes time frame now is more of I'm now scalping, so I don't use 5 minutes time frame sometimes, right? So these are the 3 different time frame I use for my entry time frame. First, on the higher time frame for my top-down analysis, once I go to this higher time frame, I want to know, right? What I do on this first time frame is I mark out key levels. Now, these levels, there are levels where I expect the price to get to. Then I also expect reversal to happen at those zones. Let me write it out. Why do I mark out this level? Why do I need to go to higher time frame? Why can't I just go to 1 minute, 5 minutes time frame and start marking out order block, liquidity, and break of structure and start taking trade? Or just go to 15 minutes and start doing that? First, I mark out this key level on the higher time frame, and these are the reasons. First thing, I want to know where price is heading. With my higher time frame, price respect more of higher time frame moves. Right now, I want to be able to know, okay, this price is going up. Where is price heading? Gold was going up. Everybody was able to easily just say, okay, gold is going to likely get to $4,000, right? So it was really going up, and everybody was expecting $4,000, and eventually it goes to that $4,000. So that's also what this key level does. It's going to help you know, okay, where do we expect the price to get to? Then since you've marked that level, everybody was now buying gold. Everybody was now looking out for buys. Nobody was selling. Why? Because everybody was expecting it to get to that $4,000. So the same thing. So since you have that level marked out, you're going to be looking out for buys till the price gets there. Then the second thing is those levels, they are possible reversal. Right, those are possible reversal zones or reversal levels. Meaning, on getting there now, price can decide to change character and start becoming bearish or start becoming bullish. Now, gold has been going up. Everybody was expecting 4,000. On getting there, it can decide to change and then start becoming bearish and start going down. Just like that. Why? Because it has achieved their goal. It has gotten to that supply zone. Just like that. The same thing. Once you get to that level, there's a chance that it can change and start becoming bearish or start becoming bullish. So that's why it's needed. Those are the 2 reasons I use it. I mark out this key level. Then is this other one now. They are for my entry, which is now my entry time frame. Now for my entry, you already know what I look out for. First, which you already know, break of structure or the change of character. It's that it has a break of structure or it gives a change of character. Then the second thing, it is gonna have the liquidity. Liquidity needs to protect the order block. Then the final thing is I'm gonna look out for order block or my breaker block. Then I take my trade. So with this, I approach the market every single time. So this is a plan on how I approach the market. So now I want to analyze gold. I want to take trade on gold. So I want to go to my higher time frame to start my analysis, start my prediction, start doing my setups, right? Start looking for my setup, start looking for opportunity. So once I go to this higher time frame, watch this closely. Remember what I mark out on this higher time frame, key levels. And these are I mark out my key level. I tend to mark out long wicks because on a higher time frame, it always tends to be long wicks. Around a 4-hour daily time frame, it always tends to be long wicks. Most times you will hardly see an actual order block on a higher time frame. So in this case now, this is a long wick, and I can mark out this long wick with a box. This is an order block, a demand zone. But me personally, I do tend to just use a line, and that's why I do call it key level. It's an order block, so I do use the line to just indicate it like this. That's where the long wick followed, just like that. But that long wick now is an actual order block on a lower time frame, so I just mark it out like this as a possible reversal zone or a possible buy zone. Then if you watch, this is another one, a long wick. I can mark it out as a possible reversal zone or as a possible zone where price is heading. So now, okay, I've marked out this very level as a zone where price is heading. So on going down, if I see that gold is going down, I'm going to be looking out for sales till it gets here. And on getting here, there's a chance that possible reversal can happen. And once it gives any reversal, I'll start looking out for buys. Then if you watch, it has another zone right here. It has this long wick. I also mark out this long wick now as an order block, as a key level. But I do tend to just use my horizontal line. I'll just indicate from where the long wick started with my horizontal line. So that's why if you watch my chart closely, you're going to see more of lines. You can see different lines on my chart. Once I'm doing my analysis, I do tend to just use the line. Now, if you watch, this is another long wick I also used. This was when I caught the buy. This was a long wick right here. Then I can also mark it out as a zone where I can easily take my trade from, as a possible reversal zone. So just like that. Now, first, gold is going down. I just marked out this box. Gold has not gotten there yet, but I just marked out this box as a zone where gold can easily get to on a 4-hour time frame. Now, you're gonna ask, why do I have different time frame? Why can't I just keep using my 4-hour time frame? This is what it is. On different time frame, it's gonna show you different things. 4-hour time frame can show you a long week. Daily time frame cannot show you. 2-hour time frame can show you another different week. So you want to go over, check out the different time frames. So what I do is daily time frame, if it's not clear, I can go to 4-hour. If 4-hour is not clear, I can go to 2-hour time frame, just like that, just to get my perfect opportunity. That's the reason I do tend to use these different time frames, right? And there are also some tips, which the video is already getting too long. I teach this in my mentorship class. You can join and you get those tips, right? On how you can easily jump on trade with these key levels, and some secrets to the market, which I'm going to teach in my mentorship class. If I say let me do it, it's going to be long for this very video. Probably I'm going to record a video on it. I don't know yet. So join my mentorship class and you learn that. But this is what I do. Since I know, okay, this is a level gold can likely get to on a 4-hour time frame, I've marked it out. Then I can go to my entry time frame. 30 minutes, that's what I love to use most times. I can go to 15 minutes as 15 minutes time frame as well. I can go to 1-hour time frame as well. Any of them, they are all the time frame I use for my entry. So since I have that time frame, I can start looking out for trades. So now if you watch, price at this order block, you can see it's an order block on the 30 minutes time frame. This was the last blue candle right here. You can see before the price actually started dropping, it created a blue candle. It created a blue candle before it started dropping. Then that blue candle now has its low, which it broke as a break of structure. Then if you watch, it had this engineered liquidity, having this high, retrace down, what goes up and take out that high. Engineered liquidity formed. Then on the lower time frame, 15 minutes time frame, there was also another internal pullback right here, but it's not clear on the 30 minutes time frame. That's another reason I do use different time frame as well. That's why I don't just go to 30 minutes time frame and then start jumping on trades, right? I don't think I'll go to 1 hour. If 1 hour time frame is not clear, I can go to 15 minutes. I can go to 30 minutes. If I go to 15 minutes now, it's going to show that there's an internal pullback. So it's now validating my setup. It's now giving me confirmation that, okay, this is valid for my trade. Just like that, because it had that pullback. Now, it had this other low, it broke straight to downside. I'm now looking out for sell. If I'm selling, where do I expect the price to get to? This very level. Now, I almost forgot to show you guys this. This is how we now take trade from these levels. This is how we enter trade. Once we have the price going up, goes down, break structure, having it first pullback, acting as liquidity, then we wait for the price to come back to this very buy zone, which is this order block right here. Then if you watch, this first order block now is now acting as liquidity, protecting this other one. So criteria are complete, break of structure, liquidity, then order block is where I'll buy from. So we place our long position too. Then our stop loss is going to be slightly below this very order block we mark out. It shouldn't be too tight. Same thing, it shouldn't be too far from the order block, just slightly below it. Then you can easily say, let me target this high as where I expect the price to break as a break of structure. So that's how we take trade with this strategy. So in this case, now it had this break of structure to the downside. Then it had this original liquidity on the 30-minute time frame, but on the 15-minute time frame now, it also has a clear internal pullback. Stop loss slightly above that high. Then I can target this low as my expected break of structure. So what happened? Price gave you clean 1:6 RR, almost 1:7 RR. Beautiful. I'm now looking out for sell, knowing fully well that this is where I expect the price to get to. And remember, we don't just jump on because the price break, we just keep adding up positions. It doesn't always work that way, right? If the price breaks, then you wait for the price to retrace, maybe to this next order block, then you continue your sell, or to the next breaker block, or you continue your sell, just like that. But since it broke, it finally just dropped without giving any other opportunity. On getting here, what do you think I will do? I will no longer start looking out for sell. I'm going to stop selling for now, then maybe start looking out for buy, because it's going to definitely give a change of character. So on getting there, what happened? It gave a change of character. This was when I had the buy opportunity from here. I had the buy setup from here, but I didn't take it. Why? Because it's a possible reversal zone. It has not given a change of character yet for me to confirm it. So this was when I had the setup for the buy, but I didn't just jump on it. And if you watch, I didn't show that buy in my live. If you watch, I didn't show that buy when I begin the class, when I begin this very video. Why? Because I didn't take it. Even my YouTube, I didn't post it on my Telegram because I didn't take it. This was when I had the setup right here, you can see. So I didn't take it personally, so that's why I didn't show it. I didn't post it. It went well. It's currently still moving in profit, but I didn't just take it because it's not how I trade. Now on getting here, I want to watch out for a change of character, and let's see if it gives a change of character. Price at this very low. It didn't break structure to the downside, so there was no break or structure to the downside, but it had this high. It broke past it. So this was the high. It broke, and that break of structure now validates a change of character. Since the price was just selling aggressively, there was no clear low it created. But this was a little low that the price created, retraced up, then come back down. So this low now can act as a high. Then on breaking past that high, that's a change of character. And that change of character has a break of structure to the downside and a break of structure to the upside. I didn't use this very break right here. Why? Because it didn't break to the downside. So now I started looking out for buys. And all you need is just your break of structure. Watch out for where the price is breaking structure to. This was a break of structure to the upside. So I'm looking out for buy. Another break of structure to the upside. I'm looking out for buys. Then I took my buy from here, from this order block. You can see the 15-minute time frame order block right here. So I caught the buy. Then this low, you can see it clearly, acted as my liquidity. Then I took my buy. I can target this next high as my take profit, stop loss below this very low, giving me my clean 1:4 RR. Right? So pretty much I can keep looking out for buys because all the break of structure that are happening now, they are now breaks to the upside. And what do you think I'm going to do? If I come back to the chart the next day, what do you think I'm going to do? I'm going to mark out another level at the top where I can see this is where the price is heading to. Then I'm going to keep looking out for buys till the price gets there, just like that. So I believe this video was helpful. And with this video, you can go to your chart and then replicate what I've said, and you're going to see similar results. Right? My students, they're already crushing the market. And if you're in this my free Telegram, you're going to see a whole lot of testimony I post about my students. Right, let me just show you a few. Then you decide if you want to join the mentorship class or not. Now, notice very person messaging me. He passed the phase 1 of his challenge. All right, notice what he said. You are now officially a funded Maven trader. Congratulations. So you got funded. This is one of my students. Then this is another person right here saying consistency. Thank you very much. My name, tagging me. My eyes are wide open now. So I teach you everything. And if you watch this very person now, he had 3 wins in a row. That's about $1,300. Another amount right there is a profit account. And if you watch, this is another person right here is now she's an October student who is currently killing the market. She caught the gold buy I took, right? She caught the gold buy I took as well. Now, these are different people giving testimony, and you can see this one catching sales. They're always tagging me, right? Once they get their setup, once they got testimony, they will tag me, and then just to show how it's going for them, right? And show, because I give them everything. If not to me personally, I'm winning the trade. So as far as I'm winning, they will definitely win because I'm winning. It's working for me. What I'm teaching is working for me. So watch this YouTube video, apply it, and then see for yourself how it's gonna work for you. Then if you wish to join my mentorship class, click on the link in the description, and then you join for $40. The one-on-one mentorship is about $300, and you can pay 2 times. So without further ado, I'll see you guys in the next video. So take care, guys.